How to trade futures on Kraken. For example, just yesterday the Secretary General of the Organization of Petroleum Exporting Countries Abdallah El-Badri called upon the regulators of the world's futures markets to do something about all the rampant speculation on his client's precious crude oil. Oil had been making overall advances in price for most all the 7 years that the folks in the oil patch held the White House. But even that steady creep didn't hold a candle to the excesses of volatility we experienced in 2008. The first half of the year saw crude oil surge some 46%, an incredible increase in view of the fact that there were no material events genuinely impacting supply or demand in that time. Sure, there were the usual storm strikes and minor military skirmishes that encumber most any trading season. But in the end, none of this actually impacted supply in any serious fashion. Meanwhile, on the demand side, we now know that the U.S. economy was already well in constant recession. And yet prices at the wellhead and gas pump continued to skyrocket. If you want to find the mysterious driving force for this first half 2008 spike, you need look no further than the trading floor of the New York Mercantile Exchange. By March of last year, speculators had racked up some 145 net long crude future positions. Now one would imagine those other fine folks at OPEC would enjoy seeing prices climb that high. $147 per barrel will buy you one heck of a new marble and gold palace, or perhaps even forestall a revolution amongst your eternally beleaguered poor another year or two. And yet this sudden largesse was making the folks at OPEC increasingly nervous. You see, they had been down this road a time or two before and had learned a critical lesson along the way. No, the trick is to place the live lobster into a pot of cold water and then slowly raise the temperature. Little fella doesn't even notice until he wakes up dead, as it were. The same is true of crude oil consumers. Crank up prices an average of 4 bits a year for the better part of a decade and no one says boo. Spike prices 50% in one season, however, and suddenly folks are looking to change their habits. Last year that's exactly what happened. Miles driven were cut back to levels unseen since the 1940s. Thermostats were dialed back, electric lights turned off, and massive subs sat languishing on auto sales lots. By mid-July, the folks at the NYMEX were forced to switch trading direction, with floor contracts showing a net short position for the first time in decades. By November, the CFTC showed 52,984 contracts speculating on further price drops. And drop it did. By December, we were seeing crude futures in the high $30s, an astounding fall of nearly 75%. As anyone in any capital-intensive biz will tell you, this is no way to run a railroad. This whole affair drives the oil types nuts for a myriad of reasons. First of all, it makes it darned hard to plan. Exploration and development take years and billions to work out. A field that seems reasonably worth exploiting at $60 a barrel may be a windfall at $120 a barrel, a tax shelter at $50, and a bankrupting boondoggle at $30.